Hey folks on the Zoom, Mark Beckett here. Sorry we're getting a little bit of a late start, just trying to get a few more people situated here on our side at the HQ in Reston, where, by the way, if you didn't get the notices, we are back live in this room. So feel free to join us here for future events, wherever here is. I don't know if you heard what I was talking about before, and figure out where we can most conveniently host this meeting, since we are going to be moving from this location too. The reason this is not super put together in here now is this is just temporary. They moved us from our ground floor up to the top floor, and I think we're moving a whole building over in another month or so. So funny stuff is going to be happening for another month or so, but we'll get it smoothed out. At any rate, thank you all for being here wherever it is you are joining us from. Hopefully you can see things on the screen. Hopefully if you are online, you are a little familiar by now with Zoom. If you're not, at the bottom there's a chat function where you can log in and type in any questions that you've got. Feel free to put your contact information in there. Those of us here will say hello in a second, and feel free to trade that information online there. But again, well, the best networking happens in the room, so encourage you to check that out there. So with that, I am Mark Beckett. I normally do these meetings with my partner, Rob Chevez, who is out traveling the country at the moment in a big red pickup truck dragging an enormous trailer, neither of which has ever driven before. So wish him luck. Hopefully Rob will be here next month after he gets back from his worldwide travels.
I'm just thinking of Grizz Wallace and National Lampoon's.
A little bit.
Yeah.
I don't want to make the full reference, but it's entirely possible. I don't know what he's going to get up to, but he's having fun. Rob has fun no matter what he's doing. So Rob and I have been running this meeting since 2009. Rob runs the CAZA Group, which is some of the signs you'll see in the room here. That's our agent side, where he has a team of buyer and seller agents, sell a few hundred houses a year here in the Northern Virginia area. I run our investments and construction division. We do rehabs, fix and flips, have some rental properties, and construction for ourselves and third-party clients, where we do just kind of typical kitchen and bath and whole home renovation things. Not so much on the investor side, because that's tough to do. I know, because I used to hire those guys, and I know what I want to pay them to do my rehab deals. That's tough to get people who know what they're doing. As those of us who have hired subs to get their work done know, that's kind of part of why we started that company, so we had our own labor force to do our own renovations. That works. Everything has its compromise, but that's part of what I do on our side. So that's me. Chip, I'll start with you. Sure. And if you don't mind, if you want to head on up, because I'm going to be leaning on you tonight. We're talking about
everybody hear me okay? I'm assuming I'll try to speak up, but my name is Chip Shear. I have been in the private lending space in various roles for about 30 years, longer than I would care to admit, or in a private conversation, I would definitely not tell you that I'm nearly that old, but it's true. So I've seen a lot of changes in the industry, and what I think we can do tonight is just have a general conversation of the state of the market and what you need to do, where the opportunities are to seek financing, and the kind of loans are available, and just really in a general sense, what your approach should be, and really what the lender is looking for from you. And then really, from a very broad perspective, what the state of the lending market is and where we think it's probably going.
So that is kind of the gist of what I've got in the way of a presentation to hopefully frame some of that conversation. And I will be interested to hear when we get to some of the kind of nittier, grittier parts of costs and leverage and things like that, what your take is on what the state of the market is, on where funding is coming from, what it's costing us, and what kind of leverage we're getting. So I do look forward to having that conversation. How do people get a hold of you to further that discussion?
They can get me at 4SB Partners.
I'll tell you what, I'm going to go ahead and
4 SB Super Bowl partners.com, and email just chip at 4sbpartners.com.
Cool. Got that in there. Cool. All right. So those online, there's Chip. Those here, we'll be able to exchange information. I've got cards. Hopefully you do too, and we'll get back to that. So let's chat. Who's who? Can you tell us?
Yeah.
Say hello. What are you doing?
All
What's up with your investing business, and what are you looking for?
So my name is Dinesh Veera. I'm new to this. So I'm actually into IT, and I'm trying to get into real estate investing and buy. I have one property that I own. It's in a kind of rental, buy and hold strategy that I got it last year. But looking to rinse and repeat and kind of scale out more on the investing side and basically the BRR, what they call it. So want to get into that strategy a little bit more. I'm new to the area. I've been in New England for 20 years, New Hampshire in particular, and moved in 2018 and got into government contracting. So currently contract with the US Army, but because of personal reasons, my daughter's going to high school, so wanted to get here. So it's been 3 years. She's a senior now, so wanted to get into more on the business side. Okay. So my reasons is to network, find opportunities, find deals, find investing, all of that good stuff.
Great. Well, you may be interested. Last month's topic was on buy and hold property investing. So hopefully, if I'm hitting the buttons correctly, these things are being recorded. Go to gridinvestor.com and you will be able to look up recordings of past meetings where we talk about various topics, including how we approach investment property and rental property and how we think the numbers work and what's a good deal and what's a bad deal. And some interesting things you covered in that topic. That's obviously a big one. So you might be able to find that there.
All right.
Welcome here. Good to see you. Yes, hello.
Yeah, so I'm Michelle. I own an e-commerce business, an apparel company. I am totally brand new. I don't have any investment properties yet. I've been reading and researching as much as I can, books and podcasts and online seminars and stuff about the past 9 months. And so what I'm looking for is really just to get started and get my first investment property and start building any kind of momentum. I'm sick of reading about it. I'm just like ready to do something.
Sure.
I don't feel like I have the capacity at this point to do anything that would require like extensive remodeling. That's not what I would want to get started in and like get over my head. So probably a single family home or a duplex or something where I could just buy it. It's almost kind of ready to go and just rent it out. So that's kind of what I'm looking for. Yeah, just get started so I kind of, figure out what it's all about. Yeah.
You can have them some resources in terms of who you should talk to, where you can read up, getting that new information, and then give you some guidance.
Yeah.
Yep. And for that, gridinvestor.com there, we're working on reading lists for our favorite business and real estate investing books. We've read just about all of them. We've taken just about everybody's course. We've paid for a lot of stuff. So we try to put some stuff there that we kind of vouch for and think works. And we're going to try to have other resources there too. Stuff from the deal analysis things to how to market for deals and just things that we've picked up. We're going to try to kind of put back out and hopefully be helpful so you can get into some trouble and go out and get you a deal. That's kind of the point. We really feel good when people go from just thinking about doing a thing to actually doing a thing. It's a huge step, and we unfortunately also have seen over the years a lot of people who just kind of accumulate information and become professionally educated investors, but then never actually put the money at risk and do the thing. And I'm guilty of some of that too, always kind of wanting to get ready or prepare or have more information. You will never learn more, win, lose, or draw, than the first time you put something, first of all, under contract. You'll immediately break into a cold sweat. Like, what did I do? This is a terrible mistake. I'm going to lose all of my money. This is a bad idea. But even if you lost all of your money, there are plenty of people who are billionaires now who lost all their money with the first thing that they did that didn't work out. But why I tell you, you learn more with the ones that don't work than the ones that do. We learn a little bit with all of them. And all I can tell you is none of this is going to kill you. Just do it. Get your hands dirty. Try a thing. You'll figure it out. You'll get better with the next one. You'll lather, rinse, repeat, and it works. We see enough of it happen. We know that it works. If you apply some reasonable strategies to things and then just repeat and get better. So
I will tell newer investors, look, the honest answer is it's like jumping into a pool. It is cold and it's wet.
Rip the Band-Aid off.
You gotta jump in and start swimming. You're not gonna get the other end of the pool just looking at it. It's cold and it's wet, you gotta start swimming.
And that's why I feel like I've just been looking at it for a long time now, and I'm like,
It's,
you know.
it's not getting warmer.
yeah, no. I'll say, and one other thing, I'm actually getting close to getting my real estate license too, so I'm working on
Great.
a lot of things.
A lot of opportunities will open up with that. A whole nother discussion about what you can do with a license, where it helps, where it's a distraction and those other things. But generally speaking, you need someone in your sphere. One of our other meetings is how to build a dream team, who are all the people that you need to know. One of the people in your sphere has got to be a realtor, right, to help buy and sell and whatever you need to do with the house. So why not at least get the knowledge for yourself, even if you're not just buying and selling for other people, just for your own portfolio, the ability to do referrals and make money for practically nothing, making a couple of phone calls. It has a lot of utility and value to it. So it's not a bad idea at all. It can be a really, really good thing. But yeah, always happy to chat about that.
Okay.
Anybody wants to chat about anything, that's the whole reason we do this, right? We want to have conversations with people beyond just this evening. So I've put my information there for the Zoomers. Feel free to reach out anytime. If you want to grab coffee, talk about the business, same thing. We're going to trade cards. Anybody wants to catch up at any time, we love that. That's what we're here for. We hope we can get your information and we'll stay in touch and hopefully we find a way to do something together. That's how this works. We know people who do things. Chip here has been a big participant in this group and helped us with information. I know we've sent him people that have made use of some funds that have been very happy and successful, and it's the basis for kind of what we do. We get people together, we talk about what we're doing. We try not to sell too many books and tapes in the back of the room. We just talk about what's working and it works and deals get done. So that's kind of what we're doing. I know there's some guys out in the lobby. We'll let them come back in and they can kind of introduce themselves, as I'm already long-winded and take too much time with the background stuff. So we'll just keep moving. All right. So that's that. Important legal stuff, by the way. I'm not an attorney, not an accountant, so don't take any legal or financial advice from me. But I will tell you what we do with our stuff, and hopefully it will work for you. And by the way, folks, anybody, again, online has any questions, hit that chat. And feel free to unmute yourself if you'd like. If you have a question, just holler. I can hear you. And we'll be happy to answer questions as they come up. So, back up for a second. The point of tonight's discussion is funding your projects. And so we start the year talking about how to market for deals, how to get the phone to ring, how to analyze a potential fix and flip or renovation or rental renovation, and kind of understand what the process is of getting yourself into that trouble, right? All right, finally, I've got something I think is going to work. Someone has said yes to the offer that I've made on their property. Now what do? You have to figure out how to actually get it closed and paid for and renovated and hopefully go through the process of either then renting it out, selling it, do whatever you're going to do with it. Funding that process then is what we're here to talk about. So Chip will be maybe less excited about this. So you have to admit, there are options beyond taking other people's money that may or may not work for you. Obviously, cash, everybody knows how that would work. If you've got the cash to buy a house, you can do it. 100% of your money, 100% of your risk, zero leverage. It does what it does. You make what you make. If you've got the money to pursue real estate that way, you can do it. I can tell you, I know a lot of people who do a lot of business, both just single family fix and flips, rentals, larger developments, obviously, probably makes sense. Anybody's building condos and office towers, they're usually not using their money. But I don't know anyone who does what I do, just buying, renovating, and selling houses, that uses entirely their own money. Maybe you do, but I don't know anybody, and for reasons that maybe will become more obvious as we talk about it. But generally speaking, I have found people who are good with money understand leverage, good leverage, and use of other people's money to enable themselves to do more than what they would normally do. Do you agree?
So I would say the first thing that people need to be acclimated with is how to compute ROI. So it's simply how much money did you invest and what's your potential return on that investment. And once you understand ROI, you quickly get how important leverage can be. Now, having cash is very valuable. Cash is like oxygen, okay? Now, the issue with cash is if you use all your cash to buy the house, what happens? You can't breathe because you don't have any more cash. And now when the next deal comes around, you're tapped. You can't take advantage of that next deal. Where I think cash is very, very important is if you have an entitlement play, meaning you're going to go buy a property in DC and you're going to make it into 3 condominiums. Okay, you're going to go fight with DCRA. It's going to take 18 months to get that approved. All right. What is very, very difficult is for you to write a check every month on a property you cannot improve. Right. So what I've seen people do once they reach a certain level, they pay cash for the property. Then they go get all their entitlements, they're ready to build, and then they finance it. So they get their cash back. And they now finance the construction based upon the ARP. It's now fully approved. So that now makes sense. But if you're going to talk to any investor, any lender, any partner, knowing your ROI is critical. So you are essentially analyzing the deal and walking in and saying, okay, I'm buying for $250. My renovation budget is $75. So my basis in this is $325. I can sell it for $450, and here's why I think I can sell it for $450. And then you can back into, here's how much cash I need, and here's what I'm going to make on the back end. And then you can quickly figure out the less cash you have invested, the higher your ROI is.
And I think that's relevant to just thinking about real estate as an investment vehicle, period. We have this discussion a lot too. Return on any investment is important to know. There are a lot of things you can invest your money in, right?
Yes.
You go buy Amazon stock is not a bad place to stick your money. Apparently Dogecoin maybe makes sense. I have no idea. But between cryptocurrencies and regular stocks and bonds and real estate and other stuff, there are plenty of places to use money. The reason why I think the people who are good at using money end up using leverage is because they understand that ROI on an already relatively secure asset being real estate financed with appropriately used leverage results in a best ROI. In fact, I can give you an example of how that works that we'll get to. But obviously cash, we kind of know what that works. And obviously you've got equity that you can pull from other things, from stocks and investments and those kind of things, if you're willing to liquidate them to generate the cash. IRAs is really a topic of its own. We all in our sphere have self-directed IRAs. My guess is some of the people that you work with to invest funds probably use self-directed IRAs for funding projects, right? Different topic. It requires a nuanced discussion on how that works and what you can invest in and what you can't. But once you have any reasonable amount of money to invest in something, whether you're still going to take a loan on the remainder of your project or not, the equity of your piece of equity in a deal can come from a self-directed IRA, and sometimes can make a lot of difference in the rate that you can accumulate tax deferred or untaxed. In the case of a Roth, it's taxed at current dollars and nothing in the future, right? Really can ramp up and accelerate your investment holdings and your retirement holdings. The example I give you for that is just Google Peter Thiel IRA. He's one of those hedge fund dudes. He's accumulated like $1 billion in an IRA. Untaxed. He paid taxes one time on, I don't know, a few $1,000s into this thing and then used the money in it to invest in other stuff. Tax-free billions. Probably the name of the book he ought to write. It's a book, right? Anyway, and of course you can get money from your friends and families, and you can raise partnership dollars, right? We've done that before too. We've done the old, all right, we know a guy who's got a lot of money. We have the time and we have the resources and we know how to renovate a house and get it sold. So, hey, give us some money. We'll go out and find it and fix it up. And when we're done, we'll split it up, whatever split it up means. It usually, though, defaults to something along the lines of 2 people, one guy's paying, the other guy's working, split it in half, 3 guys, maybe 3 ways. You get 4 or 5 people in this thing, and maybe it depends on how much somebody put in. That will determine what % of the deal they get back out of it. But it'll be some kind of combination of one person has found a deal and other people are kind of just doing other things, or you're helping pay for it, renovate it, whatever. And that's fine. That's not a bad way to do it. But I would tell you, if you're the one who's got the deal, that's the hard part. Getting funds, not the hard part. Finding somebody to fix it up, not the hard part. Finding somebody to help you sell it. In this market, certainly not the hard part, right? The hard part is finding a viable project. You find a viable project, I would suggest that there are probably a few other ways other than giving away half of it just to the person who is providing the money to get a relatively safe, when done properly thing done. I think maybe that shows up in the example too, but it gets back to what you can do with someone else's money besides a partner who is taking an equity piece out of your deal. So then that leaves us with the loans, which cost more than cash, obviously, because you pay something to use someone else's money, but could be the best combination of speed, leverage, cost, and convenience. I think when I chime in on that, we start talking about where that money comes from and how quickly you can get it. So let's talk about that then. Where you get money from. So traditional loan sources include banks. Everybody understands if you buy a house, we all went to the bank and said, hey, give me 30 years to pay you back, and I'll get you your money and give me 75, 85, 95, 99, 105% of the value of the house. There are all kinds of different loan programs out there that you can borrow money from traditional banks. Maybe it's getting easier now to get money from traditional banks to do what we do with the buying. Hi there.
Hey, how you doing?
Hey, good. Just feel free to grab a seat, jump on in. It's getting a little easier maybe to get a traditional bank to at least answer the phone and have a discussion about lending on fix and flip properties. But to my knowledge, there aren't any that are really excited about, oh, you've got a house that's got mold in the basement and a hole in the roof. Let me give you 75% loan to value leverage on this thing so you can buy it, fix it. Oh, and by the way, pay off my loan in 90 to 120 days, right?
Yeah. Now, I will say that when Mark's talking about banks, he's talking about community banks. He's talking about the Main Street Bank. He's talking about Middleburg Bank. And these are local folks with a local interest that will know and understand your real estate. What you need to understand is they're going to take a bank underwriting standpoint. So they're going to look at not only the property, have it appraised, but they're also going to be looking at your personal income, their running ratios. So the process is probably a 60-day process to get from soup to nuts all the way through but I have, and I do mostly private loans. I've had clients that have done a couple of private loans with me, and they've come back and said, hey, I'm talking to, Sandy Spring, and they had great credit, they had good income, ratios made sense, they had a good property, they got the loan, and they got it at 4.25 and 1.
Mm-hmm.
So it's available once you have that baseline involved, and they're not going to fund your first. You're going to have some degree of track record when you can show, hey, I bought properties, I fixed it, I sold it, here's what my track record is.
And in my experience, what your community level banks will do, and you're right, I don't think, I'm not knocking them, they've got great businesses, but I don't think your big brick and mortar banks, Wells's and BOA's,
just not that
you can't just go to one of those and say, hey, I want to buy a house. It's not going to be mine, and it's not going to be like my rental house. It's just some beat up house that I'm going to hopefully put some money into it and sell for a profit. I don't know of anybody that's getting loans there. But community banks maybe, and the reason I think they do it is they're trying to eventually get you into a commercial line of credit kind of situation where you've got a reasonable amount of money that is out for a reasonable amount of time. If you think about what they're doing for your fix and flip deal, why would I, as a big bank, give money to an investor to buy a currently ugly, not great condition house, take some risk on fixing it up, take the entitlement risk? You're now in the chain of title, and as a bank, you're now involved in what this guy's done in this house, well or not. Then they sell it, and if it goes the way they hope that it will, they've sold it in 6 or something months or less, and you've made 4% in 6 months after your fees as the lender. Not a lot in it for that. So even a community bank that's willing to do that is really looking to hopefully move you up into a commercial line. You're like, okay, I need like $1.5 million. I'll deploy 500 at a time in the house over here, 500 at a time over there, and they'll still want to approve your deals going against that draw from that line of credit. But they're going to want to have you approved for a larger line that you're really never going to just pay off. It's always going to be out there with doing other deals. You get to, Chip, as you were saying, a position in your business and in your equity stake that you can justify that conversation. That is good, less expensive money. It still does take days, weeks sometimes to get approval. I don't know of any bank anywhere that just says, oh, you want this house here? Cool. We'll wire the money on Friday. It still takes some time. And then that gets to the flexibility issue of how do you get something funded where when we buy these houses, that what we have to pay for them to have them make any sense. They're usually, number one, not in great condition. Number two, the seller is usually motivated by a few different things, one of which is almost always time, which means they want to get paid sooner rather than later. And we get these deals by saying, we'll pay cash, we'll
See you
pay
next
as
Thursday.
is, or it could be next week. If you're ready to go, you can get everything out of the house, or you're not even in the house and you don't care and the title is clean, we'll show up next Friday with a check and you get paid. That is a powerful motivator for a motivated seller, but you then need to be able to act on it. If you don't have cash, you need somebody that can get you that fund quickly, not usually going to be coming from a bank, but if you know of one that can fund a deal in 48 hours, let me know.
Line of credit is good to have, or I mean, I'm
Yeah,
not
so
following that.
yeah, a commercial line of credit is when a bank considers you now a business and they're not lending just to you, Dinesh, to go buy a house. They're saying, okay, your homebuyer LLC has a proven track record of being able to take these properties down, renovate them quickly, get our risk capital back in, but then get it back out again into another deal so that we know it's never exposing us for too terribly long. The money is well protected because they know what they're doing, but they keep turning it and using it and bringing it, taking it back out again. So that we're going to make our 6%, 6.5% consistently with someone who knows what they're doing. If you can establish that you can do that, that will give you that line of credit to draw from. Hopefully, and in this area, you're going to need, if you're going to be doing 2 or 3 of these at a time, millions from these folks to do this. You can establish that, and a line of credit can be at a competitive rate compared to some other options, but you do have to earn it. You have to have a track record that allows you to get into that discussion.
Yeah, and
So we cannot use our primary house as collateral and then just give me a
that's
land.
a totally different discussion now.
Yeah.
You can, if you're going into this and you're looking, how do I raise capital? The best way to raise capital because I need, and then you have equity in your house, by all means. In the equity line of credit is going to be the cheapest form of capital that you can raise.
I thought that's what he was talking about. It
No,
looks
he's
like
talking
he's
about-
talking
he's
about a
talking about business
commercial
line.
line.
I'm talking about a line of credit from a bank, a traditional, and it may still use your residence as collateral. In fact, it probably will,
Yeah.
but it's not like a home equity line. It's
Right,
literally a commercial loan. Home equity lines, as Chip says, are good. Cross collateralization using that property or any other properties is also good and possible, right? Private lenders allow cross collateralization, I assume.
They will. What you're going to find with private lenders is they are set up. They're not typically licensed mortgage lenders because it's a whole different business. So they want to lend on investment properties. So generally, most of my folks will say, I don't want to mess with their personal residence. But what they will do is they'll come back and say, hey, you got $1 million equity in your house. Go get an equity line from Burke & Herbert or Eagle Bank, and now you have operating capital. Now you can pull on that. And by the way, you're not paying on it until you use it with your line of credit with the bank. So until you find a deal, you're not paying anything for that line of credit. So that's a great way.
So it's almost, I mean, for starters at least, it's almost makes sense to do that upfront and keep it ready. So that you can get the first deal. I mean,
Absolutely.
unless, I mean, you guys have other slides that explains private
Absolutely.
investors.
Yeah, no, you're right. Using other lines of credit that you have access to is a good way to get your equity. And a home equity line of credit can be a really good, low-cost way for you to get your equity piece that you'll need to buy your deal. You don't need to have 100% of it either. You can have your piece that you're not borrowing from elsewhere come from your home equity line, and then you get the rest of the funds from somewhere else, right?
So if I have only one property, can I go to a commercial bank and say, hey, I have my primary residence and I have my one property, obviously both are on mortgage, but can you give me a line of credit for my commercial business? Can you ask that question?
You can always ask the question. I can tell you, you're going to just need to establish some history of that good, successful use of someone else's money to successfully complete some project or projects somewhere. And the higher up you go towards a kind of traditional brick and mortar type of lending institution, the less risk they're looking to take, right? That's why they're giving us money right now at 2% on houses, because they're not taking any risk on it. Not looking to take a lot of risk. So the less risky you appear, the more likely you are to get more traditional bank type funding, right? So that was Chip's point about private lending. It is really not about you. When we'll talk about this in a second, you and your personal credit and history and those things are a factor, but not the factor, because what is the factor is, do you have a good deal? Is this going to make money for you? Will it pay your loan back? Will it be a good loan for your lender? That's really the most important thing. Not the only thing, but it's pretty close. If you have a really screaming good deal, everybody knows is going to make a ton of money for everybody, it'll get funded somewhere, maybe not necessarily though by a traditional bank if it's your first deal. It may seem crazy. Like, there's no way I could lose in this thing. A traditional bank might say, that's great and all. You do that a couple of times, show us how you've borrowed other people's money and paid it off, and then we'll consider giving you some hours. You have to have a track record and show appropriate risk for what they like in their risk level.
And there's going to be different things that a bank's going to have as requirements that others wouldn't. Just as an example, I was out at a property with a really experienced investor that had a really good balance sheet, great credit, everything was sort of lined up. And he's like, so I brought my banker out here from Eagle Bank, and all the numbers lined up. But he was buying it from another investor who had already been demoed. And he looked at it and said, you don't have a kitchen in here. We can't lend against it. There's no kitchen. And of course, the investor was like, well, the first thing you're going to do is you're going to demo, you're going to pull everything out. We're putting the kitchen back in. He's like, doesn't matter. You don't have a kitchen. You can't keep the loan on. Probably doesn't have a kitchen.
Right.
So there are certain rules and conditions that are hard line, and it doesn't flex.
And that's because traditional banks like to take these mortgages, bundle them up, and then sell them to other people, right? That's how they make their money. That's what got us into a big mess the last time, because a lot of those loans were garbage, but that's a whole different discussion. That's what they're doing. That is why usually when you get a traditional loan from most banks for your personal residence, the next thing you get the next month is a letter saying, oh, by the way, your payments are not going to this guy because we sold your loan. That's what they do. That's fine. That's their business, but they need those to all kind of look the same. The collateral being all the houses in these commercial mortgage-backed security need to be in the same area, worth the same amount, roughly the same loan to value. They all need to be kind of homogenized. And what we do is really the opposite of homogenized. Every single deal is absolutely different. Sometimes they don't have a kitchen. Sometimes they don't have a roof. Sometimes the basement has a giant crack in it and there's mold all over the place. They're not like just take a bunch of these and let's just say they're all the same and they're all going to work out exactly the same. That is definitely not what this is, and that's why it's not attractive usually to that kind of big bank type of lender. But that's why a private lender will say, all right, show me what this deal looks like. There will be someone, correct me if I'm wrong, that hopefully understands as much about value as your investor will for what they're going to have when they're done. A good lender who has done this a few times before will be one of the best resources an investor can have for understanding their deal. What I've told people is, if I won't give you money, you probably shouldn't do this deal.
Yeah.
I don't want you to get hurt. I certainly don't want to lose any money. So if we're not willing to fund this, there's a reason for it. We're just looking for good deals. We're looking for a good deal for you. That's a good, safe investment for us. Private lenders are really concerned about the deal, right?
Spend a lot of time talking people out of deals. particularly in this market, because the inventory's been so tight, people are really reaching, trying to find opportunities. And when you really peel back the numbers, you look at your ROI. I was looking at a deal just the other day, and it was like, okay, you're gonna end up being into this property for $725,000 before you finance it, if you pay cash for it, all right? The out sale is gonna be maybe $850, all right? You got closing costs coming, you got closing costs on the back end when you sell it, real estate commissions and whatnot. If you don't finance it, you're gonna end up netting $70,000, right? And that's if everything goes right, all right? If your budget's higher, if it takes longer, all that stuff impacts. And at the end of the day, it was like, okay, the numbers I was giving him, he was gonna have to come up to $150,000. Taking the financing costs out of it, he's gonna end up netting $45,000. I was like, you're gonna spend a year of your life and $150,000 of your own money to make 45 grand. He's like, I don't wanna do that. I was like, so the answer is, you either have to find a way to efficiently bring the budget down, which is challenging now, or you have to get a better price. But it's better to have that conversation on the outset rather than when you're in the middle of the deal.
Yep, and that brings up another good point. We talk about a lot with the rental discussion because it really impacts rentals where margin can sometimes be a little thinner on a rental to try to make something work. But it's the same discussion. It all comes back to return. And is this a proper return, leveraged or not, for what you're risking? And so the $850 out sale on the $725 all-in number, like, oh, okay, well, I don't know, isn't there some money in there, like 70 grand? Just think about it a different way. Let's say it was 50 million. You've got a project that you're going to have $50 million in, and you're going to sell it for $50,070,000. That makes sense? No, that's a terrible idea. It's the same thing. You just have to just try to make sense of the numbers for your situation. While that's like a 0.5001% return, 0.2001% return isn't good either. So it needs to make sense on a what you have risked for it basis. And that's what return on investment really means. It's not just the base number. Great, you made 8% of your money. 8% is better than 4. But it's 8% that could have on a deal that you've got $2 million in. 8% is a rounding error on a $2 million deal. One thing doesn't go the way you think. One minor change in interest rate affecting your buyer pool on the outside, or one bad tile run in a project that large can take away an enormous amount of profit. So just think always, because this is how a lender thinks, more risk, more cost. And so for you, it's more risk, more profit. I need to have more profit from a thing that ultimately exposes me to more risk. You should not be in this market then buying $500,000 houses that you're going to put $200,000 in and selling for $895,000. There's not enough margin there, even though it's like, it'll make you 50 grand. Yes, everything works out at the end of the day. Hopefully it does, but it doesn't take much to go wrong. And 10% to the downside can happen, does happen, and that hurts real bad on an $800,000 house if you've only made $50,000, right? 10% of 800 is 80, and we're only making 50. All of a sudden, this is a bad day. So keep that in mind when we're talking about leverage and how much leverage to use.
So which also, sorry, which also means that in Virginia area, then it almost doesn't make sense to do, at least in this area, to do like single family homes, right?
I just did one. It makes tremendous sense to do, but you have to
Be at the right base.
you have to be at a good, what I would consider a good risk-adjusted price and risk-adjusted return for what you have invested in. What that does mean, and this isn't Northern Virginia, this is anywhere, you're probably not going to go on Zillow and say, ooh, I see one for sale, let me buy it, put some new tile in the kitchen, and I'll probably sell it and make some money. I don't know of anybody doing that right now. I do know people who are buying houses that are openly for sale and still making money on them, but now it's more pop tops, additions, adding square footage that isn't there. You're doing a thing that not everybody can do. Not everybody can renovate a house properly and well either at the moment, but those are the people who are probably not making money and are really pretty soon to learn some of those really valuable lessons. They'll get better on the next one. You just have to survive and advance into your next deal. But it is not easy to do this for anything, a rental property, fix and flip, anything, to just buy in the open market. We we rarely buy homes in the open market unless it's got tear down, pop top, or addition kind of potential to it, where we can really add value instead of just kind of renovate and lightly lipstick a house. So I just also want to make a quick note. I see a couple of questions in the chat. One of them is about interest rate and rental property. This is a really good question. We will get to that momentarily. Know that we're going to get to it, and please don't let me forget, but it's part of the deal. We're going to talk about costs of stuff and where you use these things here in just a second. So let's talk about it now. Typical hard money terms. And by the way, it's just really quick. The term hard money, I think, is an old banker's term about like the assets that are the basis for the loan. It's a colloquialism. It's called hard money and nothing hard about it. You got a deal, people that'll give you money for it, right?
Yep.
The hardest thing is picking up the phone to say, hey, I've got a deal. What do you think? Can I get some money for it? Find that deal. Find you somebody who knows what they're doing to lend on it. They'll give you good advice. And it couldn't be any easier to have the discussion. So hard, soft, no relevance here, but hard money is what it's sometimes called when you get money from a private individual as opposed to traditional old school bank on the corner, right? So let's talk about some of the basic terms though. Commercial uses, right? Typically these are for non-owner occupied real estate held for investment. Would you agree?
Yes.
You don't get private money on your own occupied house, right? You don't get private money on something that you're going to buy and fix up and then move into later, correct? To Chip's point earlier, this is not FDIC regulated lending. To do that, you have to go through a mortgage broker who's going to lend money to your personal home that you could lose if you don't pay it back. Whole different set of rules, whole different set of deal. This is a commercial loan. Can't live in it, can't put your friends or family into it. It needs to be an arm's length transaction for you and whoever it is that's going to be ultimately buying or occupying this property from you. And you go into these knowing that this is for a commercial profit generating venture, not for you to get any personal benefit from being able to live in it, right? I don't know anybody who's doing it because I don't think it's legal. If you're going to live in it and borrow money on it, you got to go to a different guy. You got to go the old fashioned traditional way.
The short answer is there are loopholes where the lender can make up to, it's different per jurisdiction. In Virginia, the rule was 5 loans a year to an owner occupant.
Is that right?
Without having a license.
Is that right?
However, lenders generally don't want to, once you go down that path, where do you stop? Mm-hmm. So generally they'll have a hard line saying, you don't want to mess with your personal residence. You're going to get better terms going to your bank or through a mortgage lender that is more equipped to do that. Yeah. But generally there's the ability for them to do up to 5 loans without a license to do so.
Okay. But just like traditional loans, there will be first deed of trust, notes, those kind of things. The paperwork, largely the same that you might be used to with a traditional you live in it type of mortgage, meaning you make a promise to pay. If you don't do that, the ramifications largely the same, i.e. the foreclosure process, the property can be taken back by your lender, that kind of thing?
Correct. Okay. And is there like a limit of how much they will do? Is it work for single family homes or is it like multi-unit, or what is a good time to go and talk to these guys?
So there are, in this area, there's probably 40 active private lenders. I'll tell you that each one has a little different spin, right? When I started, the way the industry sort of started was you had frankly older gentlemen that were in the real estate business. They were builders, they were developers, they owned office buildings, and they reached a point in their lives where it's hard to be out building and managing projects every day. They'd done well for themselves, but they knew and understood real estate. And they would take their money, it was either IRA money or just money that they had set aside for their family, and they created a business, and people would come to them and we'd have a discussion, and they would write a check. Okay? And eventually, that business began to take off. And as it took off, others got involved and said, well, hang on a second, what if we got the people together in this room, we got some money from you, from you, and then me, the company manager, I'll go out and make the loan, and then I'll give these guys a return, but I'll make the loan, and we'll do a pool, or we'll do a fund. And now this became more of an organized manner. So in the past, it was literally individuals writing checks that knew and understood real estate very, very well. They would know the address, they know the location, they know what's going on in the neighborhood, typically come and meet you at the house and cut a deal. Boom, boom, boom. What has sort of happened, and that still occurs, I have a number of large-scale private investors who do just that. What has happened is the business sort of matured. So there are companies that raise money on Wall Street. There are companies on the West Coast that raise money through technology. And they have a whole basis involved for how they evaluate deals. And that's driven down the pricing, and the money is a lot more plentiful. The issue is when you get with some of these bigger private lenders is they're going to have boxes, and it is round peg, round hole. So you lose the ability to do some of the structuring and some of the more creative aspects of what the old school private lending allows for. But what it does do is it allows for better pricing. So there is a benefit, and there's also, you pay for that benefit in timing and documentation and having to fit into a certain box.
But it works, private lending for single-family homes, right?
Absolutely. Any kind of real estate you can imagine. There'll be some lenders that will say, I want to do single families in the Washington metropolitan area. You'll have others that will say, now we do multifamily too. We'll do sort of a bridge financing operation for a multifamily, where you're going to buy a banged up multifamily. It's untenanted. You're going to improve it. You're not going to lease it out. It's going to take 2 years. After it's all said and done, they'll help you refinance into a permanent loan.
Probably, though, you're not going to see private individuals financing the construction of 10-story office buildings. At that point, you're looking for institutional money that really is willing to take a whole different kind of risk on the thing than private individuals are looking to do, right? But for a single-family fix and flip, townhouse, condos, rentals, plenty of private lenders will lend on a rental property, right? You just can't live in it, but if you're renting it to a stranger, and you're looking for multi-year loans, you can get that structured through private lenders. As far as
And
the
would
cost
the
of that,
ROI justify for the hard lenders? Because they would want a bigger percentage. At that point, your ROI is going to go down, right?
versus what?
Not necessarily. So ROI is predicated on how much money you're putting into it. And what I will typically do is I'll come back and I'll back into the deal. And it's like, okay, you can save yourself 1 point and 1 point rate by putting down an extra $100,000. However, you now have $200,000 invested, and your return's going to be $100,000. Okay, or you can have better leverage and have $100,000 invested, and maybe your rate's a little bit higher, so maybe you'll only make 90. But work the math. You have $200,000 invested and you make 100, 50% return. It's a good day's track. But if you have 100,000 invested and you make 90, that's a 90% return. And where it gets interesting is this all assumes you had 200,000 to work with. If you do, you now have that extra $100,000 to buy the next deal. So you could figuratively make that 90,000 again on the other deal at the same time. So instead of making 100 grand on one deal, you're making 90 grand on 2 deals at the same time because you're able to keep more money in your pocket.
Makes sense. So that's why they call it leverage. It's a lever that allows you to lift bigger rocks, right? So speaking of leverage, we're talking about the paperwork, really similar to a traditional bank loan, loan to value, the kind of leverage you'll get, 65, 70% finished value. Is that still?
Yeah, you'll see on fixed flips up to 75%.
Okay.
A lot of that is predicated on experience. Okay.
Yep.
So you're going to see different tiered pricing. You'll hear gold, silver, bronze, whatever. Gold are folks that have done, let's say, 8 flips in the last 3 years. And when they say 8 flips, they're going to look for technology. They're going to say, they're going to get the information on the property, and there's going to be somebody that's going to research and see you're a member of that LLC. And so it can't be you knew a guy that was doing it, so and you used to drive by the property. It's got to be verified that you were a member of the LLC on those 8 different deals. If you've been through 8 deals, you're now viewed as being a gold investor, which means they're going to go up to a higher loan value, and they'll require less down payment from you. And that sort of tiers its way down. So let's say you've done 3 to 8, that puts you in the silver. If you've done 0 to 3, that puts you in the bronze. You can still borrow money, but they're going to frankly say, we want to see you have more skin in the game, more capital invested, and you're going to pay more because you haven't done it before. And it's the price of doing business.
Surprise, surprise, what you're hearing is a lender talking about a risk reward exercise. What risk am I taking, right? This is exactly how you should think. What risk am I taking for my return, right? Yes.
So what about the interest rates? What do they correspond to based on gold, bronze, and silver?
Absolutely.
All right. Well,
Absolutely.
let's talk. Let's get into cost. So that maximum leverage, though, 65 to 70%, maybe on average LTV, and it depends on the experience of the investor, how good the deal is, whether we're talking 60% of $1 million or 60% of 500,000. It all depends on the risk. How much risk am I taking by giving you this money?
You also get the term liquidity of the market. So what lenders don't want to be is the top 1% in any market. So let's say you're in Reston and it's a $5 million house. They're going to say, shit, there's nothing. Excuse me. There's nothing in Reston for $5 million, even though it's the most beautiful property in the world. We don't know how quickly this is going to sell, and when does $5 million become $2.5 million? There's nothing here that supports that value. So when they set a loan to value, you're also going to look at liquidity in the market, how quickly can it trade at that number, and their I lost my train of thought.
Well, so it all comes back again to risk, right? If a private lender says, yeah, I don't really feel so good about this loan, your alarm bell should be going off, because them protecting their money was also you protecting yours.
I was going to say it's ability to execute. So when we say ability to execute, it is, okay, I have an investor that's done 3 deals, and they bought a property and they did a lipstick renovation. So they just did $25,000 worth of work, and they all went well. And now we're going to do a pop top, where it's a whole different level of construction oversight, whole different level of complexity, whole different level of permitting. So they are going to want to make sure that you've got the knowledge and the basis to be able to handle the level of renovation. So there have been times when the numbers make sense, but you have a borrower that doesn't have enough experience to undertake what they're endeavoring to do. And believe me, when I talk borrowers out of doing that, I'm trying to do them a favor, because they're looking at a $225,000 budget from a contractor, and that can become $350,000 in a hurry. And then, the lender is going to provide a reserve for the budget that you put together. If the budget's more than that, that's got to come from you. It's not in the loan. There's no place else for it.
Which gets to this last point about if you're trying to get maximum leverage from someone, I need to borrow the absolute maximum amount of money that you will give me and put the least amount of my own personal money into this deal. Probably, if you bought an old beat-up house with mold in the basement and no roof, your lender will probably say, fine, here's the maximum amount of money I will lend you, but not on day one. On day one, house has no roof and a basement. Fix it up a little. Show me your contract with your contractor. Show me your draw schedule. Show me what you think this house is going to look like when you're done. We'll all agree on what we think it's going to be worth when you're done. And then as you fix it up and add some more value to it, I'll give you a little bit more of that maximum loan that I'm going to lend you, right? That's called a construction draw. And if you're looking for absolute maximum leverage, that's probably going to be a conversation, because again, this is a risk exercise. I don't want to give you all of it on day one, because you get hit by a bus today. It's a lot more trouble for me to go back and get all the money back if you haven't done anything to make this house any better since day 2, right? So construction holdbacks are a thing. All right, So what's this stuff going to cost? Credit of the borrower, not as important as viability. We talked about that, right? You still run credit on those folks that you talk to, right?
It depends on who the investor is, but typically they would at least know.
First one through the door,
Yeah.
probably someone's going to pull your credit. Does that mean you don't get any money if you've got 500 credit? No. But it's a factor, right? Don't expect to pay the least amount if you've shown that you haven't paid other people back before. But the guy with 800 credit still gets money, just like the guy with 500 credit, maybe just a slightly better rate. So, all right, let's talk about the rate and the points.
Question, the 9 to 13% interest and 2 to 5 1.
Yep.
That seems to be very high, right?
All right, so Chip, what is it? What are we paying?
So not for a fix and flip, and it's gonna depend on what your experience is, okay? So you will find out in the market for uber experienced investors, 8% is a really good rate, okay? There are those that I have seen 6.99, okay? Those guys that do 6.99 are gonna give you a teaser rate. So they're gonna say 6.99 for the first 6 months, and then it adjusts to whatever the current rate's supposed to be. And we're gonna give you a loan for 6 months, and then we're gonna start charging you an extension fee for every 3 months after. So if you can perform inside of 6 months, you get the rate. But they're factoring that nobody ever performs in 6 months, particularly a newer investor. So they're banking on, they're factoring that in, that it's gonna take them long, it's gonna take longer. The other thing you'll see is particular lenders that will do that, they're looking at a different market, and they're looking for lower cost real estate with cheaper renovation costs. So they're looking at volume, right? So if you can do buy for 150, fix for 25, get it traded out in 3 months, you know, there are lenders that will do that at a cheaper rate. But again, they're going to look at the number of complete flips that you've done, and until you're at 7 or 8, you're not going to get close to that rate.
So let's talk about the worst case scenario, the other end of this spectrum then, the 13% and 5 points. Well, how on earth was anyone ever going to make any money at 13% interest and 5 points? Here's how and here's where. Let's say Baltimore is your first deal. Never done this before in your life. You've bought a row house. You found a deal on a row house in Baltimore that you can buy for $40,000. Probably take you another $40,000 at least to get it cleaned up. But you can sell it at the end of the day for $160, $175. Those deals happen. And actually, I think, well, I've looked in Baltimore recently, but come back to us in a couple of months. More people fill out. We get people from Baltimore down here. We actually have a group up in Baltimore that does this. You ever want to go and check out what's going on up in Baltimore? There's a lot. But in those kinds of locations, you can, if you're the first time you've ever done it, well, you tell me where you're going to get the money from somewhere else. You can either find it yourself. If you don't have it yourself, and your grandma's not going to give it to you, a bank's not going to give it to you to buy a beat up row house in Baltimore. A private lender will. But if you've not done it before and you're buying for 40, you got to double the cost of this thing just to get it fixed up and then sell it. Yep, they might want to charge you 13% and 5 points. You do the math on 13% and 5 points on a $75,000 loan. It sounds like a lot, but in real dollars, that's $7,000, $8,000, $9,000, $10,000 maybe that you'll pay for your loan. But if you sell it for the 175 and you're into it for 100, even after costs, you're still going to make 20 or 30 grand. Yes, you will pay $10,000 for your loan to do that at 13 and 5. But you're still making money, and that return on investment and that return on risk is still not bad, right? Not saying there's a lot of those out there right now, and that's just a pulled from the air example. But the point is that loans are priced on risk. If you want the maximum amount of money that I'm willing to put into a thing, and you have never done this before, you will pay more than if you've got a track record and you've done it before. It all kind of just makes a little bit of sense if you think about it that way. But focus less on the percent versus what you think is a good loan. Because, oh, I got a great loan on my house. I paid 2.9% on my house. Great. If you can find someone to give you that money to do what we do with the product we use, do it. But you're probably not in the volumes that we need. So that's where these loans come in.
Let me break that out a little bit. If you use your exact scenario, so you bought for 40, you renovated for 40. Okay, and let's say you borrowed at 13 and 5, but you did it in 6 months. So this 13% rate, you're only paying 6.5%. because you only kept it for 6 months. And you paid 5 points. So if you borrowed $70,000 and it cost you a total of 11.5% interest and points, that's $8,000. All right. If you borrowed 70 and your total cost for 80, means you have $10,000 invested. All right. Factoring out the back end, you sell it for 160 minus cost, you're at 145 minus your cost of financing, you're netting 40 grand. You put up 10,000, they made 40,000. Is that a good deal or is it?
It's a very good deal.
Yeah,
And I've done it. I've done it in DC
yeah,
a few years ago, but with very similar numbers. In Deanwood, DC, in
Yeah.
Northeast DC, about 8 years ago.
you see those numbers today down there?
No, but man, 8 years ago,
Yeah,
it was a lovely time to be alive. We could buy the thing off the MLS for 40 grand, put 40 grand into the house, put 35, I don't care, it's fine. It cost $8,000 to borrow someone else's money to do this deal, to make 30 or 40 on a cost of capital of 8 versus I'm going to make $40,000 on this. I can pay a lender $8,000 to use his money and I make 32, or I can go to some other guy that's got a lot of money and say, hey, let's do this deal. I'll give you half. Sure, no problem. Here's the money, we get half. What does that cost me? $20,000 if I give someone else half. So expensive is relative. There's nothing more expensive than giving half the profit to a stranger just for giving you the money. Don't ever do that if you've got anything remotely close to a decent deal. You don't have to do that. That's expensive. And there are people out there that will say, well, I'll give you all the money. You're not putting any money into it. No, give me 75%. There are people who make all kinds of terrible deals. You don't have to do that though, right? If the deal is good, and a lender who knows what they're doing will tell you if the deal is not good. If the deal is good and you can get the money and you can come up with the equity that you need to do it without a partner, that's where those returns can get into the high double to triple digits. We've made 150% return on money before using proper leverage, even at 13 and 5. Probably not on $1 million house.
and where
But in the right place.
it really took it interesting is you took those exact numbers, and under that scenario, you were putting 10 grand in. And let's say you had the cash to just pay for the whole thing, so you had $80,000. Well, under this scenario, you put 10 grand in. What if you bought 7 other houses with that $70,000 that you have left, and are making the same return? So being able to have oxygen, which means you have money to breathe, allows you to take advantage of other opportunities. And what I find is, and you're right to do so, I focus on what the numbers are, what the numbers are. You want to get the cheapest capital you possibly can. But as soon as the light bulb goes off and it's like, whew, I get it. I actually make more money if I get better leverage. As soon as you understand that, they're in. And it just takes some doing. It takes some.
Right. So when we're talking about the price of loans, someone did have a question on using hard or private money for rental properties. What do you think on average people are paying on
Rental properties are
rates
cheap.
for properties?
So rental property pricing has continued to go down. Here's the way rental loans are underwritten. Totally different from a fix and flip. They are going to take the lease amount that the property is generating, okay, minus all expenses. So they're going to take a vacancy factor. They're going to take your principal and interest, your taxes and insurance. They're going to take a management fee, and they're going to want to see the rental rate be 120%, 1.2% of the payment, okay? So what that means is it's a standalone. The property on its own, the rental will cover the payment. And if it does, at 120%, you can get rates down upper 3s, and that's non-recourse, totally non-recourse. So that whole mark, because it's being securitized, it's going into a big pool, it's being sold someplace.
I think I need to refi some of my rentals. So the point being,
The whole thing there is, there's no wiggle room, because it's going into a pool, it's going to be sold someplace.
Yeah.
It either hits the debt service coverage or it doesn't. What you want to keep in mind here is, while rentals have gone up, they have not stayed in line with what property values are. So if you came into DC and you're going to buy a row house for 600 grand, it's going to rent for 2,600 bucks. You can't make a debt service coverage.
right,
Unless you put 50% down, which screws your leverage entirely.
which by the way,
That's why I was asking the question earlier, in DC area, does it make sense to do that? Because
It makes sense to do when you can.
Yeah.
It is hard to do, no doubt. I am as big a proponent as anyone of building a rental portfolio. But understand that in order to use leverage to borrow money to do it, you're going to have to buy that house really cheap, dramatically cheaper than I could make money on it to flip it, right? I just did a deal in Vienna that we bought for $580, sold for $870, and we put a couple $100,000 into it. I could not have fixed that house up and rented it for the $2,800 a month that it would have rented for and covered a decent loan on it. I could have left $800,000, not eight, we could have left $675,000 in it, but $2,800 a month on $670,000 is a terrible return, right? You really need leverage on rental properties to get good returns, but then you have to buy them incredibly cheaply in this area. That is why a lot of people do a lot of their portfolio rental investing in other parts of the country, because there's a floor to rental rates, right? It's just, you can't rent anything for less than $1,000 a month for a nice house anywhere in the country, right? But you're not going to get $10,000 a month for your regular Vienna Rambler, no matter how nice you make it, right? There's a cap and there's a floor, and that floor is pretty high across the country, which makes other places besides here great for rental investment.
in those cases, by default, you go for a flip, right then.
So yeah, that's why a lot of the times the only real exit for us is to sell, because I can't just rent everything. And it kills me. There have been a few where the biggest regrets I have are ones that we sold that we shouldn't have. But you've got to, analyze the deal that you got in front of you at the time, and the cash flow provided by a rehab can be significant. And whereas a rental is just a little money every month, right? You have to build a portfolio to have it generate real money. So different considerations. But the point of the cost is usually lower because less risk. There's someone in this house paying down the mortgage for the person that owns it. We know there's a floor, right? Below rents, the rents just won't go. It's a safe investment for the lender, so you get a good rate.
So would multi-unit also follow the same methodology, because it's more expensive, but there's more units and the return would be a little bit more justifiable, or there also the cost is very high?
The
So
cost for financing,
The cost of the unit itself. So the reason the single family in Vienna wouldn't work, because the cost of the property is so high and the rent is only at a certain level. But if it were a multi-unit, and if you can get it at again, goes back to the deal you get, right?
Yeah.
So I was wondering if
So
multi-unit is
think
also
in
more
terms
expensive.
of locations, okay? And I had some really smart investors come to me and said, okay, here's our model. For every 3 deals, we flip 2 because it creates cash, oxygen. And our third one, we rent. And they had a model where they had a rental portfolio that just wasn't local. They had a property manager someplace, and this was Dayton, Ohio, frankly. And they said, we buy townhouses in Dayton, Ohio for $50,000. They rent for $750. Can you do that here? No. And they told me, they said, the bad news is, if you go back 20 years ago, they were selling for $50,000. 20 years from now, they may still be selling for $50,000. But they're making 15% cash on cash off of a property that's not encumbered. So they would take their money, and when they made 50 grand, they'd go and they buy another townhouse for cash, and they were banking $750 a month, every month. But you could, but you couldn't do that here, because you're going to see cap rates, 3.5%, 4%, or you're getting 15% in Dayton. And one of the reasons you're getting that in Dayton is it's not the same kind of economy. So the jobs aren't there, so there's not that kind of growth. But there are people that live and work there that need a place to stay.
And so what that equates to is that this is a very expensive real estate market for rental ownership, right? It's difficult, it's expensive for everything, but for rental ownership, you're really going to have to score on your acquisition to have the numbers kind of make sense versus fix and flip. Fix and flip is usually a good bit easier because you don't need to buy it quite as cheap to cover the debt if you're taking it, or just to make a good return regardless of where the money comes from to do it, to get a good return on rental, because the margins start a little bit thinner. You have to buy much cheaper, which is hard to do here. All right, so the point here was already made about the cash rate of return being higher with leverage than it would with a partner, right? Stands to the reason. Worst case scenario, 13 and 5 is still less than half, right? Do not give up half of a good deal. Internet, people in the room, right? No one give up half of your deal to anyone if you can borrow money, come up with the equity that you would otherwise need to get this thing done, even at what might feel like a higher rate than you would be used to paying. It's still cheaper than 50%. It will always pencil out to be cheaper than 50%. And by the way, you don't necessarily need a partner to bring the whatever 50 grand you might need to do your $300,000 deal if you're borrowing private money versus the $300,000 you'd have to raise from somebody to do the whole thing in their cash, then still giving up half of the deal, right? Use the leverage of someone who's just looking to get a good return on their money, and don't get it wrong, 13 and 5 is a real good return on your money when it works out, but remember there's risk, right? It still happens. We know of lenders that do still occasionally have to take houses back because this is a complicated process and stuff happens. I don't see it very often though. I don't know if you're willing to discuss actual rates of failure and foreclosure on average loans.
So one of the things you saw, some of it was COVID related, was everything got slowed down. Yeah, so permitting was slowed down. You couldn't get construction workers out there. So you had a project that was supposed to take 6 months, and now you're a year into it, and you're still not done. And there was, certainly at that time, there was, I call it lender fatigue, because the lender's been hearing the same story about how we're progressing every month.
Yeah.
So what happened was there was a bunch of borrowers that had to go back and get their loans reset. So they found another lender to come in and take out the existing lender, which I don't care what you're paying. If you have to refinance twice, it's not worth it for you. Okay. Now, one of the things that happened in that time was you had originally forecast the property was going to sell for 300 on the market, like up crazy. So even if you had to refinance twice, it's now worth 400, and you have $100,000 in bound equity. And even if you were paying interest all of that time, and even if you had to refinance it again, it still made sense. I look at a lot of scenarios where it's like, yes, but if this had sold for what you had originally forecast, it would have been a break even, and the 100,000 you made was the fact that the market kept going up, right? And that's a great position to be in. Our issue is you just can't forecast it going forward. You can't look at the market and say it's going to continue to go like this. You have to look at what is the now, what is today, what's the status of the market. And one of the things that I like about the business is you're not necessarily having to forecast 3 years out and look at, what the economy is going to do in interest rates. You look at it, inventory, where things trading for, and where within 6 months we can expect it to be fairly static. So that's one of the advantages of this kind of business, is that you're not having to look globally at the economy and what happens with oil prices and inflation and all of these other factors. Election cycles.
Right. Done right, your regular old bread and butter fix and flip rehab should have a risk exposure of like 6 months, right? 7-8 months max if you're really dragging your feet, or you have a lot of work, or you haven't done it, or your contractor's slow, or whatever, right? But that is different than a downtown DC 8-unit condo conversion that's going to take a year just to get the approval to start, and then another year to build, and then another 6 or 8 months to sell out of units. So what does that mean? More time, more risk for someone, right? So that's what impacts the price. That's the first thing that everybody focuses on when the discussion comes to borrowing somebody else's money. What is this going to cost me? I would suggest you first think about, what am I risking and what am I asking the other person to risk that is giving me money? That will explain better what it's probably going to cost you to do. And if you've got a thing, there is such a thing as transactional financing. You guys do like short-term bridge day loan, super.
I know some trouble with that, but I've never really.
Most cases, but this is actually a good discussion for the topic in general, because we're talking about borrowing money from someone and having to have some equity to put in it, right? You're getting 60, 70% LTV, you're probably going to need to bring some money. If you don't have that money to put into the deal, or the only way you can get it is to borrow from a private person who's going to want to take 90% of it because you're putting in absolutely nothing. They're putting in 90% of the money, and hopefully it makes money at the end. I would suggest maybe you're not rehabbing. You should wholesale that. If it actually has some money in it, bring it up to an investment group, or maybe just take my card. And when you've got a deal, but you don't have the cash to fund it, just sell the deal to somebody else, because you can make a quick 5, 10. The most I've ever paid for the paper, for the contract, is $100,000 for the deal. Guy didn't do anything and made $100,000. We didn't do anything, did a lot, got a phenomenal price on a house, sold the contract for 6 figures. And that's not even close to the highest money I've ever seen anybody pay for a contract. So there are other ways to make money from a good deal besides doing it yourself. But if you don't have the equity to put into it, you shouldn't have to give up 90% of the profit to someone else. Find another creative way to extract the value from this deal that you, from the opportunity that you have found. That's what a contract does. But day financing is when you, for whatever reason, can't just sell the contract, what we call wholesaling. Sell it, you have to buy it, but you've already found a willing buyer to buy it from you at some much higher prices. It's a good deal. Maybe it's a title thing. There are a few reasons why it can happen. You can borrow that money for the day that it takes for this transaction to close in season, and then you sell it next day, same day, to the next guy. I've had to do it like once, I think, for some title reasons. You can use this kind of funding for that. Really good rates of return. I don't care what the guy's charging me. Again, it's less than half whatever it costs to make a good chunk of money in 24 hours is a really powerful thing. I want to miss a couple of questions. So they're asking about down payment for a rental house. What are the other terms for private money for a
rental house?
Yeah.
So the most important part is the debt service coverage. So you'll find rental financing up to 80%, but it has to be 1.2 debt service coverage.
Okay, explain that one more time.
1.2 debt service coverage is, let's say your rental rate is $1,200.
Mm-hmm.
The total expenses, including PI, TI, vacancy factor, so they're factoring in what's the market vacancy for a given market,
okay,
and management fee, cannot exceed $1,000. So that's 1,200 divided by 1,000 is 1.2.
Okay.
Okay.
Leaving in that example, then $200.
$200 in profit, and that the $200 in profit is kind of a worst case scenario because it's factoring in a vacancy, which you may never have a vacancy. But what a lender is going to look at is they're going to say, yes, but the market is 6%. So if you own this long enough, you will succumb to what the market bears. And if the lender is going to say, yes, but if we own this property, we have to turn this over to a property manager, and it's going to cost us 5% in management fees. So we have to factor that into the underwriting. Okay. So it's 80%, but you also have to hit the debt service coverage. And if it doesn't hit the debt service coverage, the only way it works is for them to lend you less. So it's hard, particularly in this area, to take that 80% and take it to the bank and say, I know I'm going to get 80%. It's awful hard to make the debt service coverage work.
Unless you're getting a real good deal on the property.
Unless you're getting a real good deal on the property.
Back to the discussion about in this area for a rental, you got to get a real good deal on the property. It happens. We got, every once in a while, you find a motivated seller. We've got a property we bought for $75,000 in Woodbridge, put $30-something thousand into it. It's worth 200-something thousand and rents for $1,650 a month. I would love to have a couple hundred of those. I'd probably quit. But they're not that easy to come. It doesn't happen that often, right? I could easily sell that property for a $75,000 one-time payday would rather keep it in a portfolio, let a tenant pay it off, and then eventually just have several of them paying $1,600 or whatever it is in 10 years a month in cash flow to replace an entire income. That's why you build a rental portfolio. And then the question was how long you typically hold a property for a fix and flip. I am suggesting that done correctly, around 6 months on average for a traditional single family townhouse, one condo at a time. You bought it, you're going to add some value to it and hopefully sell it for more than you got into it. If there's any reason why it can't be done in 6 months, it's probably not a good idea as your first deal to be doing, right?
Yeah.
But we've
But
done.
where do you find these kind of deals? So that's part of the, I mean, maybe it's another session.
Oh, that's many months worth of discussion about where these come from. But the short answer is there are 3 ways to find a real estate deal. Marketing, prospecting, and networking. Marketing is taking the message and sending it out to as many people as possible. I buy houses, call me if you got one. Prospecting is going out to the market and just knocking on doors, throwing offers at stuff on the MLS, just taking proactive steps to you go and find the sellers and say, hey man, sell me your house, right? Directly. And then networking, what we like to do, talk to enough people, tell them you're in the business of buying houses that maybe need a little bit of work from someone that has something going on with a problem that they need solved. That's what we do. The real estate is my widget, but what we do is we solve problems for people, right?
And I'll give you another scenario. So I've seen this work a couple times. It wasn't my idea. I'll take credit for it. Whatever. Guy finds a deal. It's in an emerging market. So you're in an area where, let's say there's 50 houses in a neighborhood and 10 of them have already been improved. You can feel it coming, but there are 40 others that have not been improved. Guy finds a deal, renovates it. It's in perfect condition. And they make the business decision to say, Friday night is for the neighbors. The open house is on Saturday and Sunday. So they physically walked around to all the neighbors and said, hey, I know this has been a giant pain. You know, there's been a lot of mess and dust and construction debris and noisy. We want to thank you for putting up with us. Come on by. We're going to have whatever. We're going to have a fruit tray, whatever. They're coming into a finished product. And they are, where are they coming from? They're coming from their own dump because they're already in the neighborhood. I will tell you, you already know what that product's going to sell for because you're doing it. You already know what's going to cost to improve, and you already know who your buyer is going to look like. You've already done all the hard work. All you're doing is you're now broadcasting what you've done to a captive audience, to grandma who wants to go down by her grandkids down in Florida, but she's got this house, it's a mess. What's she going to do? She comes walking into this beautiful house. The other thing is, it's the softest sell you could ever do. You're not going, hey, you got a crappy house, we'd like to buy it for a song. They're coming into your house. You're feeding them, and you're just having a conversation. They're looking at how beautiful this property is, and then it's a natural conversation. Hey, would you like to buy my house? You even have to ask them. And what that does is now you know exactly what's going to cost you to renovate the house because you just did it. You know exactly what your buyer's going to look like. It allows you, we like to say, build a sandbox. Because now, let's say you get 3 properties in that neighborhood. How do you manage 3 construction projects? It's all hard unless you're in the same neighborhood and you're parking your car and you're walking around all 3. That's kind of how you build a business. And that is maybe a goal, but it's just an idea of where do deals come from. Deals come from doing deals. So I said, gotta jump in the water. Figure it out. Because once you're in there, you know, things come up, ideas happen. And this was an idea I got from a borrower and got 3 other deals from it. Same neighborhood.
I started a construction company around it. There's other ways to maximize the value of your project.
There you go.
Okay, so yes.
On a hard money loan, who does the note? Who creates the note?
Who creates the note? So they will typically have lenders counsel, okay? Some will have them in-house, some will have just private counsel. That is, they work for the lender, and they're gonna write, you know, deed of trust. And I mean, essentially, it says, if you pay, you stay, if you don't, you won't. Basically what it says.
And what does it cost to have someone draft those documents?
About $1,000.
That the borrower typically pays,
Yes.
right? Another good point. Other things that you might expect to pay for borrowing someone else's money. If you have those construction draws, right? I need all the money you can give me. I've only got X dollars to put in this deal. It's just enough to get it done, but I'm going to need it all. Fine. I'm going to have some construction draws as you get the house fixed up, add a little value, reduce my risk. I'll give you another check that you can give to the contractor, blah, blah, blah. Expect to possibly pay fees for inspection in those draws, right? Because somebody's got to go out and look at this thing, make sure that your contractor did what they said that they were going to do somewhat properly, that the value's been added to the house. It's just drive time and analysis and stuff. So you'll pay a couple of bucks for draw and construction fees. I think Chip made the point earlier, get whatever terms make sense for how long you think you're going to have this house. Hopefully you're talking to a lender who isn't going to try to sell you on, oh, let's do a 3-month term. I'm sure it'll be fine. You get it fixed up. And in 3 months, if you don't, well, we'll extend it. Extension almost always costs a fee, right? To say, all right, I've gone beyond the length of time that we agreed with in the beginning, you'll have to pay some kind of fee for getting some additional time, because it'll be the lender's option to give you that additional time or say, no, I'm sorry, that's how much time I gave you. You need to either sell that house or we're going to have to come and take it. So you're not going to get 10 years to do your fix and flip deal, but you should probably get more than a couple of months. And what that length is a thing that you will negotiate with the person giving you the money, but know that if you need more time, usually it costs more money, right?
Yeah.
That's really the bulk of it. I don't know. There are other fees. Some lenders charge like application fees and stuff for putting the thing in and have them look at your deal and vet your project. You probably would only need to pay that the first couple of times. And by the way, what you're really paying for is that answer from someone who does nothing but look at real estate projects all day long. If they're willing to give you the money, then great, fine. It was another 100, 150 bucks. If they're not willing to give you the money, that was the best $100 you ever spent to find out that, ooh, maybe I shouldn't take money out of my IRA and go sink it into this thing, right? So application and review fees are nominal compared to the value. If it keeps you from doing something not great.
Will they tell why they are not giving the money?
Of course, yeah, right. You always tell somebody exactly what it is you don't like about a deal if you're looking at it, right?
Yeah.
What are reasons that you told people this doesn't make sense besides just the house isn't going to sell for enough?
Well, margin's a big thing. Liquidity is a big thing. So one of the things you'll hear from a lot of lenders is they want to be in either an urban or at least a suburban area. And the reason they want to is because they have, call it a ticker tape. It's like, okay, I have a split foyer. It's 2,100 square feet. It was built in 1964. If you're in Vienna, you have 100 split foyers. Okay, and you can see what those have all sold for. Now, if you're out in
Ransom, West Virginia.
West Virginia, and you have a custom home that's sitting out there, and there's nothing around it that looks like it, and there haven't been any sales, how do you really know what that property's going to trade for? It becomes a much more risky proposition because you can't put your finger on what the number is.
And we know people who are doing that, right? Because it's hard to get deals around here. So everybody drives around until they find this beat up old house that they think maybe they can get for a cheap price that makes some sense. And maybe it does. But again,
it's harder to borrow against that asset.
Risk is risk, whether it's yours or the lender's. Your lender is always going to be a good check on, is this maybe too much risk? I agree. One guy one time did the thing that you did way out over here on your island of price, location, or whatever it is. Maybe we don't do our first deal with the thing that's only been shown to happen one time ever by one other person, right? It's all about risk. So that affects the price, the availability of the money at all. The lender may say, fine, I'll do it, but it's going to cost you more and I'm not going to give you 70%. I'll go in for half of that. You can come up with the rest. Take the risk if you want it. But your loan terms are always going to be a very good reflection of the viability of your project. If you can buy a house for $100,000 that any guy with a pickup truck can renovate for 10 grand, and you can put it on the market for $800,000, I will give you that money tomorrow, right? At a real good rate. You don't even have to put hardly anything in. Show me a valid contract and the contractor, we vet all that. You can get 100% of the money. Will that ever happen? Probably not, right? I don't see that happening very often. but that's the no risk proposition. High risk gets turned down once it gets too high, and cost is going to be on a spectrum somewhere in between, right? And the higher the cost usually means the higher the risk. So you've got to be thinking, is it worth my risk to do this? And your lender is a good sounding board for what risk is. Did that answer the question about like other locations and costs of funds?
I have a question. So would investor from this area lend money for a property somewhere else, like Texas or Michigan, where the deal on paper looks good, but would that happen?
Depends on who the investor is the short answer. Generally, most of the private lenders, individual private lenders, want to be, you took Washington Capital and you said 90 miles in any direction from Washington Capital. So I can get to the property if there's a problem, so I can see what's going on, so I can analyze the neighborhood. I'll tell borrowers, because they'll bring me deals. I'm like, yeah, I was down there yesterday. It was beautiful. It was quiet. I was like, okay, I know this neighborhood. Go back there at 8:30 on a Friday night and tell me what you see. You know, so it's the ability to know that market and be in that market. There's those that'll do it. There's any number of large national lenders that are underwriting on a desktop where they're pulling up the picture on Google Earth and they're looking at comps and they're just plugging in numbers and it's round peg, round hole. And that money's readily available, but it is gold, silver, bronze, based on what your experience is, and it's going to have to fit into a box.
So I would say short answer is yes, you can get funding for any good deal anywhere in the world, certainly in the continental United States, right? And you don't even have to be there, but risk reward, right? All right, so you've somehow found a great deal in Texas. Well, how are you going to make sure that that job gets done properly?
And
right?
that question will be asked.
And so that's going to get.
How do you know the
priced in.
contractors out there every day? I tell people, it's like, look, I get very happy when I pull down the street and I can't get down the street because there's all kind of construction cars. They're active. Somebody's trying hard. How do you know that's going on? And what you can assume is if you're not there, that your contractors will launch all that. You can just assume that. Hopefully, that's not a proper assessment, but I find location is important, particularly for newer investors, because you can find a reason to go by your property every day and see what's going on. And, you know, having a drop by with your contractor just so that he knows that you're checking on him can be very valuable.
Well, I can tell you as a contractor, he's not out at lunch, but he's probably doing somebody else's job.
Yeah,
And we all have more work than we know what to do with. So keeping them on your job is definitely a thing.
Let me talk about draws really quick before we wrap up, because this is important. Okay, you get a deal under contract, you have a $100,000 budget, you go out and find a contractor. The lender is going to fund draws as work is complete, so not in advance. Your contractor is going to say, I need a 50% deposit up front. Get started on because I'm so busy, whatever. We have a running joke about the contractor that has a boat and the name of the boat is First Draw. So if you write them a check in advance for 50% of your contract amount, they're now going to take that money and they're going to buy materials for every project they're working on and not just your project. So what does that mean? You no longer have control or leverage over why didn't you do this on a certain date. Now, if you cut a deal where you say, I'm going to pay you as you make progress, maybe you give them a small deposit to buy materials. Now you can hold them accountable and say, I'm going to pay you this $20,000 after you've completed this work. And that's important because the biggest factor, once the deal gets to a certain point, the numbers generally work. It's a matter of time and budget. It took too long and it costs too much. So anything that you can do to control that takes that risk out of the equation. And that's highly important.
I look forward to buying that boat.
Yeah.
I guess I'll have to name mine Second Draw, but
Right,
we'll see
right,
how
right.
that works. All right, get your questions in here if you've got them on the Zoom chat, because we'll be wrapping up in a second. But I see one asking about a real estate license. We talked about that earlier. Do you need one to do fix and flips? Absolutely not. I don't have a license. But are you going to need someone in your sphere with a real estate license? Absolutely. All of my partners have real estate license. So Is a license necessary? No. Is it helpful? Almost always, unless you routinely partner with someone who has the license. Even then, unless you have some relationship with that other partner where you can also send them all the easy money for agents, right? Because by the way, you may not know this, you can make money as a real estate agent on somebody buying a house in California. If your friend said they're selling their house in San Francisco, and you happen to know about it, and they haven't picked an agent from anywhere else, and you set them up, say, I'm an EXP agent, I'm a Keller Williams agent, I'm a Cole Baker, whatever. They have an office in San Francisco. I'll bet I can do a little research, find out who's really good in that office. If you want a recommendation, I'd be happy to give it. You give somebody a referral in another part of the country, they will pay you usually 0.25% or more of the commission just for sending them a referral. You don't have to do a thing. You just have to know a person selling a house. That actually is how my partner Rob ended up with his license, because he ended up talking to all these people, because we just talk about buying and selling houses a lot, that we don't buy every house that we look at. We buy a small fraction of the houses we look at, but they are for sale. Somebody wants to sell them. All agency is wholesaling, right? Which is wholesaling. We control the property with a contract, and then we make money for that opportunity that we control with the contract. All agency is wholesaling with a listing agreement instead of a contract. I now control it, right? When it sells, I get paid. All I have to do is find a willing buyer for this house. So thought about that way, agency makes a lot of sense. It's a great business too. So there are opportunities that come with a license that allow you to profit from things that you otherwise might not be able to easily profit from. So that is the answer to have a real estate license. Any other questions?
I have
From-
more on the wholesaling stuff.
Yeah, go ahead.
So does it make sense to network with the wholesalers, because they would have access to probably a lot more leads?
Short answer is yes. A wholesaler is a person who, as their job, goes out and tries to find these motivated sellers, put the property under contract, and then sell the rights to somebody else. Doesn't want to buy it, doesn't want to get dirty, doesn't want to borrow anything, just wants to buy it and then sell you the contract so that you can go and do your thing, right? Absolutely, it is a very good idea to know those folks if you can. I would argue that a really good wholesaler is also really good at finding a lot of people who want to compete for that opportunity, right? And competition always increases the price of the thing, right? So a lot of people out there who say, I am a wholesaler, I'll sell you a thing. Far fewer of them that are selling them at prices that I typically want to pay. There's usually somebody that wants to pay more, or is willing to pay more for a house than.
It is a good way to get started because they actively have deals under contract. Those are live deals. You've got to do your own due diligence at what you think it will sell for, and not what they think it's going to sell for.
Right.
And just know.
And then on the base, the
number.
deal should make sense, right? Not the wholesale.
Yeah,
If the deal makes sense, the deal makes sense, and then lever that, because the much better opportunity, back to my scenario, now you have a finished house, now you're showing off the neighborhood, now you have neighbors coming over. The soft sale, that becomes your next deal. You're not having to go through a wholesale. You have actual people coming to you, asking you to buy their house. But you gotta start someplace, and they do have active inventory. I just look at wholesale deals all the time, the range are really squeezed.
yeah. But by the way, if you want to meet wholesalers, you meet them here. There are probably a few of them online, by the way. If you are a wholesaler, feel free to put your information in the chat. Even if you're not, feel free to put your information in the chat, and you can always click at the bottom of the thing and copy and paste and get everybody's information that is already there. But coming to things like this, participating in these kinds of discussions we've got a cool Facebook group. If you're not already part of it, absolutely free, by the way. It's Grid Investor on Facebook under groups, not the regular page. It's a group, right? Which means you have to ask to be let in. We let everybody in, but we make you ask, because if anybody gets like spammy or weird, we can kick you out, because all it's there for is for us to talk about our business. And you'll just see a lot of people saying, hey, I need a contractor. Hey, I've got a deal. Hey, what do you think about this property? And there are wholesalers who say, hey, here's a thing, right? There are professional wholesalers who are part of our group that say, here's our deal. here's what I think it'll sell for. Here's when it's got to close. Hit me up here if you're interested. So join those groups, join groups like this, talk to other people. You will run into people who are wholesaling properties, and it is a good way to get access to deals. That's, again, why we do it. So that's why we encourage everybody online and elsewhere, join that group. See us at thegridinvestor.com for recordings of these kinds of meetings, when we're going to announce the next one, and of course, to get access to that investor network on the Facebook group where you can hopefully find some deals. So with that, I'm going to split with the online folks. Hang out here for a little bit. So next time, if you want to do some more networking, come to the meeting, because we'll hang out for a little bit and talk some shop. But otherwise, we will see everybody online at the next meeting. And thank you for coming out tonight. That was a